Good morning, everybody. On behalf of Vetiva Capital Management and our media partners at Frontier Africa Reports, we would like to welcome you all to our breakfast meeting and thank you for joining us this morning. It is Wednesday, the 7th of July, 2021. As always, this meeting is set to last for 30 minutes, inclusive of Q&A. The meeting is also being recorded and it's also being broadcast live on our Vetiva online page on Facebook. Over the course of the meeting, if you do have a question, you may use the Q&A chat box and you may leave your question there, which we'll attend to after all speakers are done. And this is the same for those joining us on Facebook. On our agenda today, we'll get a rundown of the equity markets from Cheryl, our global equities trader, after which we will move to Omorige for fixed income and currencies. Additionally, Joshua Odebisi, our banking analyst, will be speaking to us on an investment case for Nigerian banks. And after this, we will round up with our media partners from Frontier Africa Reports and their own updates. So without further ado, we will start off with Sheung from the Global Equities Desk. Good morning, Sheung.
Good morning, Chidoze, and good morning, everyone. Thanks for joining us this morning. Like Chidoze mentioned, I'll be doing a quick review of performance of some equities markets in West Africa. So we'll start off in Ghana. Yesterday in Ghana, the index closed marginally lower by 5 basis points. We saw equal number of gainer and loser in the session. Specifically, I think Society General ended the session higher with 109 basis point appreciation, and we saw massive loss in Unilever, which pulled the market to the 5 basis point lower return we saw yesterday. The likes of MTN, Cowbank, Society General continues to dominate the market activity, and we believe this should filter into today. Year-to-date return in that market remains positive at 36.53%. For our expectation for that market today, we expect activity level to improve with a chance of the market reversing yesterday's loss, given the investors' demand, particularly around the likes of Enterprise Group, Fan Milk, as well as Society General. So we believe this should play out in the market today. So we'll quickly move to the BRVM, and just like in Ghana, the benchmark index closed the session lower. We saw that largely on the back of losses in the likes of CFA Motors and CIE Cote d'Ivoire, just amongst the other guys that closed lower. And speaking to activity level, this improved quite significantly. We saw both volume and value closing higher in that session. And as expected, the likes of ETI and Sonatel dominated activity level as investors continue to trade in line with corporate earnings release. I think that's what we've seen in that market. We also saw mixed sectoral performance as the BRVM 10 continues to lag the broader index, while industrial and transportation sector showed minor appreciation. For our expectation for today, we believe earnings release will continue to, just like I mentioned earlier, the earnings release will continue to influence market direction, and we expect some mid-cap names like Safka and Cital to close the session higher today. So, and like we've always mentioned, for any of our clients or listeners that are looking at exposure into any of these markets, please kindly reach out to us at send us an email at dealing@vetiva.com, or you can also reach out to us through our sales team. So you can send an email to sales@vetiva.com as well, and then we'll get back to you. So finally, back in Nigeria, we saw a third consecutive gain for the All-Share Index. The session ended 52, I think we're 52 basis points higher, which was we saw that largely driven by sustained gain in the banking space, which is just in line with our expectation for the session. I think remember yesterday where we mentioned that the banking will continue to see some level of demand and patronage in the banking sector. So this pushed up the index. Also, for some other names that contributed to that upward movement, we saw Seplat with a 714 basis points gain, as well as Total also contributing to the upward close. And for the oil and gas space, we saw that this was expected as Brent continues to inch up. I mean, the standoff between Saudi and UAE, as well as just in line as OPEC Plus as well, continue to delay. So I think this means this has been positive for the oil and gas space, and we might likely see that continue today if this standoff continues. The positive sentiment also was broad-based, as investors cherry-picked across sectors. So we saw that in the market yesterday, which led to about 29% increase in market turnover. And just looking at the sort of investors that we're seeing in the market, the retail investors are still we've seen them to be the most active in the market. As foreign portfolio investor, those investors continue to shy away from the equities, from the local equity space in Nigeria, and we might just see that continue for a while for now. So having said that, for our expectation for today, we expect market to maintain the positive run as investors continue to pick up on the banks, particularly in the tier 1 names, while also taking position in some consumer good names in anticipation of decent Q2 numbers. We also continue to watch the global space to see how the oil price and oil politics continue to play out, and we believe this will affect some names in our market. Overall, we expect positive flows for the equities market today. Thank you.
Thank you, Seun. We will now move to Omoroge for fixed income and currencies. Good morning, Omoroge.
Good morning. Supported by OMO repayments of about 29 billion that came in yesterday, system liquidity improved significantly to open around 205.76 billion.
I had done a test, an ECG test that I was asked to go and do at Rainham last.
Sorry about that, Omoroge. You can start over.
System liquidity improved significantly yesterday on the back of the OMO repayment of about 29 billion that came in. So we saw it improve to about 205.76 billion from the 117.94 billion positive that was recorded on Monday, spurred by the improved system liquidity. Interbank rate declined by an average of 50 basis points, as OBB and overnight rate closed at 9.75% and 10.25% respectively. Our expectation for today is that the money market will trade at similar levels, barring any significant change to system liquidity. Parallel market remained stable yesterday to trade at 503 naira to $1, while the earning window opened at 411.5 naira to $1 during the course of the trading session. The highest rate that was recorded was 420.86 naira to $1, while the closing rate was 411.45 naira to $1, which is a 32 kobo depreciation from where it closed on Monday. Brent crude lost about 2.97% yesterday to close at $74.87 per barrel amid the OPEC Plus crisis as traders speculated that the breakdown in talks could lead to higher supplies in the market. We also saw WTI crude lose about 2.04% to close at $73.64 per barrel. The TB's market traded on a very muted note yesterday, with few buy-side interest seen on the tail end of the benchmark curve. However, most of us seen in the market yesterday were on the short end, especially on the October 2021 and the November 2021 papers, but the bids on that end were very weak. So we didn't really see much trades consummated on that end. Most of the trades that were consummated in yesterday's trading session were on the CBN Special NTB 28 April 2022 maturity and the newly issued one-year paper, that's the June 30th, 2022 maturity. Overall, average benchmark rates remain unchanged day on day at 6.24%. The OMO segment traded on a relatively active note yesterday with a slightly bullish bias, as the OMO maturities of about 29 billion that came in yesterday spurred buy-side interest on the long end of the benchmark curve, particularly on the March and the April maturities. Overall, average benchmark rate declined marginally by 2 basis points to close at 9.51%. The bonds market recorded another muted trading session as players continued to stay on the sidelines and wait for the release of the Q3 FGN bond issuers calendar. Rates are gradually starting to turn the corner as offers on the 2015 maturity inched up by about 5 basis points yesterday to settle around 13.15% levels from the 13.1% levels that was seen in the previous trading session. We also saw offers inched up by about 10 basis points on the 2027 maturity to trade around 12.35% levels from the 12.25% levels that it traded the previous day. This slight uptick in rate that we have seen in the market goes against the general expectation of a further moderation in rates on the back of the significant maturities that are coming in this month. So we can't say for certain if this is going to be the trend going forward or if it is an aberration. We'll most likely get more clarity in subsequent trading sessions. We also saw late demand for the 2023 maturity with a bid of about 11%, but the best offer in the market was around 10.35, hence no trade was consummated on that end. Trades that were majorly consummated in yesterday's trading session was on the 2050 maturity, and they were done at about 13.15% levels. Overall, average benchmark rate increased by about 5 basis points to settle around 12.48% at the close of yesterday's trading session. The local Eurobond space traded on a mixed note yesterday, with buy-side interest seen on the sovereigns, while we saw sell-side interest on the corporate. Most of the buy-side interest that we are seeing on the sovereign, we are skewed towards the longer dated maturities, the 2030, 2031, 2032, Nigeria 2038, the 2047, and the 2049. Average rate declined by about 2.7 basis points on those traded sovereigns. In the corporate side, the most traded active corporate were the EcoBank Eurobonds and the First Bank Eurobonds. Average rate on those maturities inched up by about 3.44 basis points. Our general expectation for today is that the current sentiment in the bonds market will persist as investors continue to cherry pick offers across the benchmark curve, while the TB's market will most likely trade in line with system liquidity. That will be all for fixed income.
Thank you, Omar. We will now move to Joshua Odebisi, our banking analyst, for his presentation on an investment case for Nigerian banks. Good morning, Josh.
Good morning, Chidozie, and good morning, everyone. So I want to quickly take us through a few pieces of analysis on Nigerian banks in comparison to some banks across Kenya, Ghana, and Egypt. First, to just give a little bit of context, this year, I think we've seen the banking space has continued to trail the All-Share Index. And last year, despite closing positive by about 10.9%, the banking sector underperformed the All-Share Index. Now, historically, that has not been the case. And the banking space has been some of the best patronized or best followed sector in the Nigerian market. However, I think this does create an opportunity for investors due to the fact that we believe that the Nigerian banks are generally undervalued, especially in relation to a number of their peers. Now, if you can just move to the first slide, please, Chidozie. Here, I've just done a very broad analysis looking at the listed banks in Kenya, Ghana, Egypt, and comparing them to tier one banks in Nigeria. And we see that in terms of market capitalization, obviously, we have our giants, GT and Zenith, followed closely by Access, UBA, and then FBNH to a lesser degree. Now, this is just compared to the average market caps of the banks in Kenya, Ghana, and Egypt. I have the full breakdown in a later slide, so I will show you all the banks that were included in this analysis. But basically what this is showing you is that in dollar terms, in real dollar terms, market cap for the Nigerian banks generally outstrips most of the banks across these other markets, even though the Egyptian market is serving a much broader market that goes into the Middle East, your Qatar and your Kuwait and your Bahrains and the like. Yet the Nigerian market still competes and even surpasses them quite significantly. Also, in terms of free float, what we've seen is that the free float in these other markets is not nearly as high as it is in the Nigerian market, where we see the free float on average much higher, is about 83% or 84%, if I'm not mistaken. Now, also what we've seen is that despite the moderate returns or the modest returns in the Nigerian market, there has been quite significant in the last 12 months, there's been quite significant returns in comparison to the banks in these markets. So overall, I think this, presents a very, very appealing investment case for Nigerian banks, although that I think is already self-evident. Then when we move on to a very important metric, which is dividend yield, you can see that among the tier one banks, dividend yield obviously has been quite impressive. When we look at the Kenyan market, for example, and the Ghanaian market, I think the Ghanaian market has been quite impressive with dividend returns, although they are still working with a bit of a smaller pot. They have the fewest listed banks of all the regions that were analyzed. But overall, in terms of real returns between the last 12 months and dividend yield, if you were invested in Nigerian banks, I think you've gotten a pretty significant and much more effective return than even the current inflation rate. The next slide, please, Judith. So here, just to do a quick analysis by way of valuations, I think what these graphs are showing, or what they're trying to present, is the fact that overall, I think the Nigerian banks are slightly undervalued, especially in relation to their international peers. The Kenyan market, for example, the price to earnings ratio is 6.4 on average. I mean, compared to the return on equity of only 9.3%, that shows that signifies that they are quite significantly overvalued. And then when compared to the best performer in the Nigerian market, GT, with a return on equity or average equity of 27.1% compared to price to earnings of only 4.2 times. I mean, while it is comparable to Ghana and Egypt, the ROE gives you the indication that it's significantly undervalued in relation to all these stocks. And the same goes for the rest of the tier one names, save for maybe First Bank, which I think you would say is overperforming. Then with regards to return on assets, again, the Nigerian banks in general have a bigger spread or bigger mix. However, your GTCO and your Zenith are head and shoulders above the rest. Same goes with price to book valuation as well, where you see that GTCO is the only one that even approaches 1.0 times price to book valuation, However, if you look at the table, which is in the next slide, you will see that Kenya, Ghana, and Egypt have several banks that are priced to book at 1.0 or close to 1.0 compared to the Nigerian market, where you'd see that Access Bank and UBA especially have very, very low price to book valuations. And I think this presents a very, very strong case for the fact that I think definitely medium and long-term Nigerian banks are extremely undervalued. And obviously there are a lot of other external factors that play into that. However, what I will highlight is that despite the fact that our inflation rate is quite high compared to these other markets, this actually presents a very strong opportunity for the Nigerian banks, obviously due to the CBN's policy stance, which gives the banks a lot cheaper access to cheaper funding, although that is somewhat eroded by the high CRR debits that we've seen. However, just to point out that that high CRR was in place throughout most of last year and still is in place till now, and yet the yield on assets for these banks, most of them, except maybe GT to a small extent, has been improving. So they have been more efficient with converting their cash, even though a big chunk, up to 35% of it, is being debited for CRR. They're still very, very efficient at turning that cash into earnings. So I think there is a very strong case for the Nigerian banks, especially in the tier 1 space, but also in the tier 2 space as well in the long term. And I think that it is definitely, when compared with your international banks in your Kenya, your Ghana, your Egypt, some of your largest markets. I mean, the Kenyan market basically serves a huge part of Eastern and Southern Africa. And then your Egyptian market serves, like I said, is like a gateway into the Middle East. And then your Ghanaian market is a bit of like an alternative market to the Nigerian market in some ways. So all these markets, I don't think any of their banks really compare to the Nigerian market. You can just go to the next slide, please. So this is just to look at the full breakdown of all the banks that were used in this analysis. You can see that in terms of profitability, I think you'd say that your equity group holdings are rightly at the top, but they also have a price to book valuation of 1.4 times. Then you have your KCB group also, but these returns on equity do not really come close to what we see in the Nigerian banks. In fact, I'd say, except for maybe your FBN, most of our banks easily surpass the top banks in Ghana. Next slide, please, Chidozie. Then in Ghana, this is where we now start to see quite high returns on equity. Your Standard Chartered Bank Ghana, although their float is quite low and their price is relatively high, but their price to earnings is 5.2 times. So again, valuation-wise, I'd say that Nigerian banks are definitely doing as good as or better. Next slide, please. The Egyptian market is obviously very, very interesting, just because although the biggest bank, the Commercial International Bank Egypt, has an ROE of 20.2%, they don't have a very strong dividend yield. Their dividend payouts, as you can see, in the last 12 months, most of the banks did not pay out dividend, only Credit Agricole Egypt and Commercial International Bank. And that, taken in relation to their 12-month return, shows that if you were invested in the Egyptian market in any of these banks, chances are unless it was maybe a Suez Canal bank, for example, you would have gotten lower returns. So that will be everything for these banks. Just the last slide to show you what our coverage is currently doing and what they've done so far. Obviously, like I said, you could see the tier 1 banks are very much comparable to any of those banks on the international space. However, Stanbic does have quite a high price to earnings ratio, but their return on equity is very strong. And in the last 12 months, none of the banks in our coverage have returned anything close to negative. So yeah, that would be everything. Thank you very much.
Thank you very much, Josh. Before you go, we have a question for you, and it comes from Tumi. Their question is, what is your outlook on GT code? Do you reckon the whole code structure will be more income assertive in 2021?
Okay, thank you for those questions. First, just to go over GT code, the outlook is still positive. In our report, we did highlight the fact that GT has maybe suffered a little bit with regards to yield on assets, but obviously the efficiency will help them to maintain strong and positive earnings growth. However, with regards to the holdco structure, chances of it becoming accretive in 2021 are very, very slim to almost none, just due to the fact that obviously the structure has just been formalized at the start of H2, and the chances are we will not start to see all the elements of the holdco structure were already in place before the structure came into play. However, there will obviously be some formalizations which will increase costs as well. So we will probably not start to see the benefits of this until sometime in 2020. Just to answer the other two questions about CRR debits and strong earnings. So the reason why we have continued to see strong earnings despite the huge CRR debits, like I said, is to do with the banks effectively managing the assets that they do have, whether it be through the issuing of loans or through investment securities. And also, of course, one of the biggest buffers that they had was FX revaluation gains. That's really helped to prop up non-interest income quite significantly. So the bank have been very good at managing their treasury activities. Obviously, investment securities have not been giving as high yields as we've seen in recent times, but their FX positions did help them to book some significant revaluation gains, which really propped up 2020 earnings. Now, that might be to a lesser extent in 2021, but we've obviously seen some revaluations happen over the course of the first half of the year, and it is not impossible to think that there might be further revaluations down the line. However, their yield on assets on just loans and advances have still remained strong. So I think we have to just give it to them on those fronts. And then the last question about if political turmoil, informality in executive latitude and pension to override state policies and the rest, more than 12 months paying no interest until November 2020. Yeah, all of these things have been factored into the valuation. Again, like I said, the truth is that the banks, especially Nigerian banks, have managed to effectively improve earnings and profitability year over year, despite all of these challenges, especially, CBN policy shifts over, the last few years, the political turmoil, the economic turmoil. These things have remained, and yet the banks have continually shown that they are effective at managing the rough terrain. So I think that all of these things have been factored into our valuations, of course. Thank you. That would be all.
Thank you, Joshua. We will now conclude with Temple Asaja from Frontier Africa Reports and their updates. Good morning, Temple.
Morning. Quickly, from the eastern part of Africa, Kenya's PMI came in. It's the market Stanbic Kenya's PMI. It was a bit of a decline from the 52.5 to 51 reading this time. We understand that the contraction is due to the effects of the 60-day COVID-19 restriction that was reintroduced late last month. Uganda's current accounts for the first quarter of this year, the deficits declined to $710 billion. Money supply was up 8.68% year on year. Vodacom CEO in DRC, the Democratic Republic of Congo, is now the chief executive officer appointed for Safaricom's Ethiopian unit. They'll be moving there because, you know, the Safaricom and Vodacom consortium to get into the Ethiopian markets led to that. We understand that British Petroleum is now looking to switch its direction to now Africa. To cut investments and exploration since the beginning of this year due to compliance with climate change overhaul and all that. They've been reducing and cutting down, downsizing across the globe, across their offices the world over. So now they're facing Africa to also trim that. Ghana is looking to also start trading its in cash crops at its that's on its commodities exchange. They've been doing more of grains lately. They have 10 warehouses nationwide. Now they're looking to integrate vegetables and a couple of cash crops. Zimbabwe is introducing its 50 Zimbabwean dollar notes today. It's to basically help to ease transactions, and some 4.2 million US dollars equivalent of that is to be injected into the banking system. Currently, what we know or what we understand is that the 50 Zimbabwean dollar notes is equivalent of 59 cents in terms of dollar terms now, and you need about 100 Zimbabwean dollars to be able to buy a loaf of bread. Actually, South Africa's alcohol industry is demanding 1.5 billion rand from the revenue agency in that country by way of excise duty. That is because the government has had to shut down alcohol, ban alcohol sale again for some 2 weeks, and they did estimate the loss at 6.1 billion rand. So they are demanding 1.5 billion rand in excise duty by way of a compensation. Finally, Egypt has got its PMI for the month of June also out. That came in at 49.9, just a little less than the bump, or lower than the bump rather, and then it was an improvement basically from 48.6 in May. We understand that output and new orders have increased for the first time since November. And of course, there's been a slight resumption of activities in the tourism sector. These are some of the headlines we can share for now. Thank you.
Thank you for your update, Temple. Unfortunately, we have come to the end of our meeting today. If we're unable to treat any questions you may have had, please don't hesitate to send us an email at research@vetiva.com, and we will get to you as soon as possible. On behalf of Vetiva Capital Management and their media partners and Frontier Africa Reports, we would like to thank you all for joining us today. We look forward to having you join us again tomorrow morning at 8:30. Good morning.